I don't know if it's just me or if you guys also feel this way, but like, what's coming next for stocks? See, I've been in the markets for a long time, and most of the time it's pretty clear to see what's coming next. But right now, there's so many different bullish and bearish indicators, bullish and bearish sentiments and takes from different Wall Street banks, hedge funds, and institutions. If you listen to Nike's earnings call, well, you probably think a recession is coming. If you look at the markets, it doesn't look like a recession is coming. If you look at what the markets are pricing in for Fed rate cuts next year, it looks like we might be looking for a recession next year, or inflation just continues to fall off of a cliff. See, as we get closer to the start of 2024, there's a very bullish argument for our markets and a very bearish argument for our markets. We're going to break that down here in this video, give you the latest analysis and updates that you need to know, and discuss what I think is coming next, because famous last words, I think I know what's coming next. So let's get into it. If you guys find value, and only if you find value out of this video, hit that like button, consider subscribing to the channel, and let's get started. Nike just dropped over 10% after they reported earnings, but they actually just had a record Black Friday. This says, quote, "We outpaced the industry, driving growth of close to 10%. Nike Digital had its strongest Black Friday week ever, and a record number of customers shopped in our stores over the long Thanksgiving Day weekend." But then Nike says, quote, "As we look ahead to a softer second half revenue outlook, we remain focused on strong gross margin execution and disciplined cost management," they said in a press release. This plan is to lay off thousands of workers, will cost Nike between $400 and $450 million in restructuring costs, mostly due to severance pay. So Nike basically told us the consumer is tapped out, and we're not expecting crazy numbers for at least the next 2 quarters. Then you have this. A leading economic index declined for the 20th month in a row, the longest down streak since 2007-2008. The conference board is now forecasting a short and shallow recession in the first half of 2024, pushed back from the prior calls for a recession to start in Q1, Q2, Q3, Q4 of 2023. Or what about this? Titled "The Bull Trap." This UBS analyst sees the S&P 500 falling to as low as 4,110 in the first half of 2024. If you track the S&P using the SPY, which I think is probably most of you guys, that would be around 410 on the SPY. Right now, we're at 475, so that would be quite the pullback. They say, despite the recent breakout in the S&P 500, UBS technical analysts are urging caution as they see potential for a bull trap developing in the U.S. stock market indices. With a number of divergences in our indicator work, toppish trend momentum, our sentiment frame in outright contrarian territory, the too low volatility, and taking into account extreme oversold yields, we still think that current breakouts is the setup for a classic bull trap instead of believing in the start of a larger breakout campaign, this analyst wrote in a note. He also says there's a potential that the S&P 500 is on its way to set an important tactical top as a setup for a negative surprise in Q1. UBS says in early Q1, we expect a first meaningful reversal as the setup for a negative surprise in U.S. global equities, with an initial target projection of basically 410 on the SPY into late Q1, early Q2, they concluded. And just so everyone's on the same page, this would take the SPY down about 14%. This would put you back to your November lows during this crash correction event that we experienced just a couple of months ago. Then you have Citibank saying, quote, "The message is to expect pullbacks and buy into them." You even have Apollo that says risks are rising that easier financial conditions triggered by the Fed's pivot could start another rise in inflation driven by higher prices on housing, labor, services, and goods. I don't believe inflation is coming back nearly to the same extent as we seen prior. Could we bounce in the 2 to 3 range? Sure, but I'm not expecting this runaway inflation at all. I think that is probably the lowest chance. I think there's a better chance stocks fall and we go into a recession than inflation just ramps back up again. Tom Lee says, whoa, sounds like some serious equity buying might be taking place later this week. That is because JP Morgan said, quote, "Market volumes are light, and it does not take much to get this market moving, especially considering that SPX flirted with all-time highs today. As such, once market makers and traders realized that today was nothing more than a successful attempt to take advantage of a massively overbought market and let out some of the air that had been hoped to accelerate the gamma squeeze into a full-blown year-end melt-up. The result will likely be an even more zealous attempt to ramp risk higher, especially since selling like today perversely validates and reinforces the Fed's dovish pivot, thereby making even more aggressive buying the most likely result." I mean, geez, that really couldn't be more bullish. That was from JP Morgan on the Wednesday flash crash-like sell-off that we seen towards the end of the day. What about the pricing for Fed policy in 2024? Some rate cuts are probably warranted because inflation is falling aggressively. But this many rate cuts, maybe that's signaling some weakness in the economy that's expected. Now, the Fed just came out and said they were going to cut rates 3 times in 2024. The markets say, no, you're going to cut rates 6 or 7 times in 2024. We are far off. So either the markets are saying inflation is going to be gone in 2024. We might experience deflation, so you could take rates all the way back down to about 3.5%, give or take. Or the economy is going to weaken. It seems like you can make an argument at this point towards maybe the economy is weakening, just given how far disconnected we are from the Fed, and the Fed basically just saying they were going to cut rates 3 times has led to this runaway expectation of rate cuts. Now, I think the Fed should be cutting rates now, personally. So don't hurt the messenger, right? But if we start to price in more rate cuts than 6, what we're currently pricing in, this could be a problem for stocks. Usually rate cuts are not seen as positive. Usually stocks crash after the first rate cut. Usually rate cuts only happen when the economy is doing poorly. So if the economy starts to do poorly and the Fed starts to cut rates, odds are this time will be no different. Stocks could sell off on average 25% again after the first Fed rate cut. That's the historical precedent. If you get a strong economy, then stocks are going to do better. If the economy is not strong and starts to look poorly, well, yeah, stocks are going to look very poorly as well. So I think it's important to point this out. Currently, we're pricing in 6 rate cuts with 39.2% odds. 7 rate cuts is at 32.8%. So we're almost pricing in 7 rate cuts. Now, it's pretty clear the Fed's not going to do anything January 31st. There is an 18% chance the Fed will cut rates, an 81% chance the Fed will continue to pause. It would be a shocker if the Fed did anything besides nothing coming January. But with that being said, if we price in 7 rate cuts, that would be a rate cut at every meeting after January. A rate cut in March, a cut in May, a cut in June, a cut in July, a cut in September, a cut in November, and a cut in December. If you start to price in, let's say, 8 rate cuts, because maybe we do get some weak economic data, you're going to be pricing in a 50 basis point rate cut at one of these meetings. I don't think that's good for stocks. You also have Tom Lee basically giving credit to himself where credit is surely due, how he predicted a 25% rally in the indexes, the SPY, triple Qs at the start of 2023. That seemed stupid at that point to like 98% of the market participants. That turned out to be true. He went on CNBC on December 20th and said, basically, recession is not going to happen. Inflation is going to continue to fall. There's a lot of money on the sidelines. Hedge fund managers are 65% of them are underperforming the SPY ETF, the index. That's a good reason for money to come back into markets. And I think so. But stocks do not go up in a straight line. And that's where we come to a bit of a short-term problem. And that's basically what the SPY triple Qs have done over the past couple of weeks. I've been bullish. I expected this ever since we bounced in November. I've been bullish the whole time. I've profited immensely from this rally. I've done very well. And I do think there's a little bit of right and wrong on both sides here. I think some hedge funds, institutions, money managers, portfolio advisors, people that manage money are a little bit wrong in their consensus about 2024. I don't necessarily believe we're heading into this recession the way that Wall Street thinks. But they do have a point. The economy will slow. The data will slow down. We're not going to be at 5% GDP, 4.9% GDP for Q3 for coming quarters. It's going to slow down. That's a fact. Think about it like this. Stocks don't actually sell off when a recession happens. Stocks sell off before a recession happens, because you start to get the data and the data starts to look real bad. And then the markets start to say, wow, we're heading into recession, and sell stock. By the time you actually enter in a recession, you usually bottom the first couple of months upon entering a recession. But most of that steep sell-off already happens before you enter a recession. So if the data starts to look really bad, then you're going to see a sell-off in stocks. And the way that we have positioning right now that has been very bullish recently, the VIX sitting at very low levels, although it has been trending up a little bit from the recent low that we set, it is starting to trend up, but it's very low. Seems like most people right now are pretty bullish. I mean, the biggest bear on Wall Street, Mike Wilson, just flipped, and now he says stocks can rally. That's a pretty good contrarian indicator that people are bullish out there. If you look at the latest AI investor sentiment survey, I mean, this is public data for everyone. You are at a new one-year high for bulls. Bullish investors at 52.9%. Historical average is 37.5%. Historical returns on the SPY, the S&P, are very good. I mean, his historical averages of 37.5% bulls is pretty bullish. And now you're at 52.9%. Neutral investors at 26.2%. Bearish investors at 20.9%. But you did hit a low of 19.3%. So what I'm trying to say here, really, let's cut down to the chase. In the short term, you could sell off. Now, how bad you sell off, how steep you sell off, really comes down to the economic data. How bad does the economic data get? Does it look really bad or just a little bit bad? Either way, you probably get a sell-off. But if you get just a little bit of bad economic data, you could probably fall back to the 450, 440 range on the SPY. That would be my expectation. If data starts to look really bad, then you could fall back to the, 420, 410 area, potentially lower than that, but I think it would have to look really, really bad at that point. But I do think for 2024, especially the second half of 2024, you probably do get a continued rally in stocks. Now, maybe we're setting the high for 2024 right now as we enter 2024. I'm not so bullish on big tech and the broader indexes. I'm very bullish on interest rate sensitive names, a name like a Tesla, IWM, small mid-cap quality names, because they are beaten down. PayPal was $300 during 2021. It is $63 and some change, barely off of its lows, multi-year lows back to 2017, where it hit $50 so dollars. I mean, there's a lot of stocks that are still beaten down that I think will rally big time in 2024. But it's going to be one of those things where if you look at the markets on face value, you're going to say, maybe stocks are not doing well. Maybe the SPY, the triple Qs, they're not doing well. But maybe under the surface, stocks are doing well. Kind of like what we've seen in 2023, where the indexes were just ripping higher for this whole period. But small and mid-cap stocks, the average stock was not doing anything because the indexes are market weighted to Apple, Microsoft, Amazon, Google, and those stocks were doing well. In maybe a little bit more simple terms, I don't think Magnificent 7 names are going to be magnificent in 2024. Thus, if they're not magnificent, the weighting is too high. If those stocks do not do well, the indexes will not do well. But the rest, of 25,000 or so other stocks listed on exchanges could do well. So I do think there will be a pullback. I don't know how steep it will be, but I think there will be a substantial pullback at some point in probably Q1, maybe Q2. And then I do think 20 trillion or so dollars on the sidelines will help this market rally in the most beaten down names. You want to go for beaten down, high quality right now. I could be wrong, though. Let's be honest. Like I said in the beginning of this video, this is a very hard market to try and, come to grips with what's going to come next. A lot of times, in the past, especially 2023, it was pretty easy to see what was coming next. Right now, it's very difficult. Let me know what you think about all of this information down below in the comment section. What is your expectation for 2024? Is Santa bringing coal or presents coming over the next couple of days? Let me know down below in the comment section. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.